Y'all wanted more market wizard wisdom? Well, AK has got it. AK's also got a sore throat, so bear with me. Just bear with me. JK, I'm a bull. But today we are gonna get some lessons from Mr. Bruce Kovner. Now, Bruce Kovner was a cab driver who became a trader who became worth $5.2 billion. He was one of the people interviewed in Jack Schwager's Market Wizards. And if you remember that previous video from last week or so about Michael Marcus, well, this is the guy who Michael Marcus trained. So Bruce retired in 2011 from his hedge fund that he founded and ran for 28 years. Over that time, the fund returned an average of 21% a year. In comparison, the SPX just averaged 11%. Kovner only had one losing year in '94. That's it. And when Bruce was trading back at Commodities Corp, which, I explained is where all the legends come from, he averaged close to 90% over 10 years. It's insane. So let's go over some wisdom from one of the best to ever do it. So on having the necessary vision, like I said, Michael Marcus was the guy who taught this guy, right? So he says, Michael Marcus taught me one thing that was incredibly important. He taught me that you could actually make $1 million. He showed me that if you applied yourself, great things could happen. It's very easy to miss the point that you really can do it. He showed me that if you take a position and use discipline, you can actually make it. And supposedly how the story goes is that Michael Marcus just took Bruce Kovner up to his office and he just pulled out a check and he's like, look at this. And Bruce was like, that's $1 million on a check, because he was a cab driver, right? I mean, he didn't believe you could even make that much money. And Mike is like, yeah, how you like that? And that was kind of the key that unlocked Bruce's brain. And he was like, wow, so this is actually possible. And this happens all the time, right? People just need to see that it's possible and then they go out and do it. So once the first person broke the 5-minute mile, a bunch of people started doing it. Once they broke the 4-minute mile, you had a bunch do that as well. It's that saying, seeing is believing. Now in this video, we're gonna focus mostly on risk management. And by the way, I'm talking about Michael Marcus, but if you haven't seen that video, I'll link to it right here. Definitely go check that out. It's a good one. Now in this video, we're gonna go over Bruce's advice on risk management. So he said, I would say that risk management is the most important thing to be well understood. Undertrade, undertrade, undertrade is my second piece of advice. Whatever you think your position ought to be, cut it at least in half. So the first thing traders end up screwing up is they trade too much. Like Bruce is saying here, you should be under trading. But because we all have access to markets in our pocket, through our phone, we stare at charts all day. And when you stare too much, you start wanting to do something. It's natural when you see that red and green constantly flashing all these notifications. You become a bit addicted, So you start taking trades you shouldn't have. You take trades that are outside of your trading plan. That's how you lose money. So that used to happen to me all the time when I was a discretionary trader. But it got a lot better when I moved to a system, which of course I'm going to plug the Nasdaq All-Star system again, because I seriously love that system. It's all momentum based. It solved a lot of my problems like over trading. And if you want to learn more about that, I'll link to it right here. You could click it, watch that video, I explain it. But the nice thing about the system was that it was so automated that I didn't really need to look at the market. I just look at the market once a week now. And that's good for me, because if I'm sitting there and looking at the market all day, I end up making trades I'm not supposed to, just like most everybody else. So the more I stay away from charts, the better off I am. And that's just my personality. And that system helps me do that. Bruce said that his second piece of advice is whatever you think your position ought to be, cut it at least in half. Now, we just talked about position sizing, right? The risk way to size positions. If you haven't seen that video, I will link to it right here. But a huge thing that traders do is size way too big, because in markets, you're going to lose a lot more than you're going to win. And you need to keep your position size smaller so that you can survive all those little losses. And you need to be making asymmetric bets so that when you do win, that little bit that you risk becomes a lot of profit, and it covers all those losses plus more. But the problem you see a lot of new traders do is they just bet too much and then they blow themselves out. So me personally, especially when I was discretionary, I was always conservative with position sizing. Sure, my profits wouldn't be as big, but I wouldn't be knocked out of the game either. And a lot of this game is just surviving. Next, wisdom. Through bitter experience, I have learned that a mistake in position correlation is the root of some of the most serious problems in trading. If you have 8 highly correlated positions, then you are really just trading one position that is 8 times as large. So everybody talks about having a diversified portfolio, right? But then they have all their money in the stock market. So yeah, there is some diversification between stocks. But say all your money is invested in 8 stocks like Bruce is talking about. Well, guess what? When there's a market crash, all those stocks are going to go down. Doesn't even have to be a market crash. Just in general, all stocks kind of move together. Now, I'm a momentum trader, right? So I know all stocks move together, but of course, in a bull market, some stocks will move more than others. So I want to place my money in those stocks. But with momentum trading, when things go bad, I'm in cash. I'm not trying to pick the few stocks that are going to buck the trend. Because first of all, if they do go against the trend and actually go up when the market is going down, they're not going to make much. And second of all, it's very difficult to find those stocks. So even if you are spread out in your portfolio amongst different stocks, it's still pretty much having like just one position in stocks. But of course, there is the benefit of diversification. Like if one stock has bad earnings report and drops 20%, you don't have all your money in that one stock. That's still smart. You don't want to put all your money in one stock. But there's a difference between diversification and diversification. That's why people put their money in real estate, bonds, commodities, so that you're not just in stocks. So hopefully those different asset classes move differently. And then that's the real diversification. Whenever I enter a position, I have a predetermined stop. That is the only way I can sleep. I know where I'm getting out before I get in. The position size on a trade is determined by the stop, and the stop is determined on a technical basis. So this last sentence right here, position sizing based on the stop, risk position sizing. That's exactly what we talked about in that last video I made, which again, it was right up here. You should go watch that if you want to see what Bruce is talking about. Like I said, a lot of discretionary fund managers use this risk concept of sizing their positions as opposed to notional. And if you're using that methodology, then you are always going to have a plan, because you need to know where you're going to get out before you get in. You got to know your entry and your exit, and based off that, you size your position. So it's kind of a good discipline thing, because if you don't know where you're getting in and out, no way you'll know how much to put in. So it kind of stops you right there if you don't have all that laid out. My experience with novice traders is that they trade 3 to 5 times too big. They're taking 5 to 10% risks on trades when they should be taking 1 to 2% risks. This is just reiterating what we said before, traders trading way too big, size smaller. And you'll see when you watch that risk position video that a 1 to 2% risk to your portfolio, that could still be a large notional size. It means you're investing a lot of money, like a lot of dollars, but you're only risking a little bit because you have a stop in place. See, all this is all about having your stops and risk control in place. It's the most important thing about trading. The only thing that disturbs me is poor money management. Every so often, I take a loss that's significantly too large, but I never had a lot of difficulty with the process of losing money, as long as losses were the outcome of sound trading techniques. So in trading, you got to be able to take a loss. That's just the name of the game. Like we discussed before, the reason you're sizing your position smaller is because you're going to lose a lot. Some of the best traders only have a win percentage of 35%. The rest of the time they're losing. So Bruce is saying he is just fine with taking a loss. He takes losses all the time. The only time he's not fine with it is when that loss is too big because he screwed up his position sizing, or he didn't take his position off at the right time, so it was poor money management. Now I always say picking a stock is only 10% of the process. 90% of the process is actually managing your position. And that's where this risk management comes into play too. It's all about process and having that plan in place and then executing on that plan. A common mistake is to think of the market as a personal nemesis. The market, of course, is totally impersonal. It doesn't care whether you make money or not. Anyone who's been trading kind of gets this feeling, because it always seems like the market just goes against you and you almost start thinking it's out to get you. But I think the way to get around that feeling is to really understand how markets work. So understanding cycles, expected value, how your strategy fits into the market, really getting deep into those concepts will keep you from getting emotional, which is exactly what it is when you think the market is out to get you. Whenever a trader says I wish or I hope, he's engaging in a destructive way of thinking because it takes attention away from the diagnostic process. Bruce is all about execution. He's all about building the process and carrying out the process. So there should be no I wish or I hope involved. There should be no emotions at all. You should just know, does your strategy have a statistical edge? If it does, then keep executing. You're going to get losses, let them go. You never know what the next trade is going to bring you, win or loss. All you know is that over the full cycle of your strategy, you should be up. So if you're wishing or hoping when you get into a trade, you probably need to take a step back and learn a little bit and build a process first before you're jumping into stocks. That's why we talk about process so much on this channel. And we go over all this wisdom from the market wizards to prove to you and me that what we're talking about is correct, because they all did the same thing. And if you want to see more wisdom from all these guys, then check out this playlist that I'll link to right here. You can go watch those videos from Ray Dalio, Stan Druckenmiller, Bruce, Michael Marcus, and I'm going to keep making these videos. We've written all these articles already on macro ops, so it's nice reviewing them with everybody at Fallible. If you want to see those videos, make sure you subscribe to this channel and hit that notification bell so you get an email notification when they're released. We're publishing videos almost every day, so subscribe and I will see you in the next video. Stay fallible out there. Bye.